Hey, I'm so glad that we are together today. I'm going to put up my share screen so we can just review today's topic on banking. And it's one of my favorite topics because of how important it is to low-income families. Banking is the first step that they have in creating prosperity. Remember that the definition of how do you increase prosperity for someone is you increase their ability to trade. So that means for an individual, that means for a family, that means for a small business, that means for a corporation, that means for a state, that means for a country. If you can increase people's ability and availability to create trade, you will increase their prosperity. And so banking is the first place that people are learning to trade. So today I'm going to go over some real basic terminology. We're going to talk about the difference between banks and credit unions and some banking goals and some little known facts, and just kind of go through what is there. One of the things I remind people about is that most people are using 97% of their money within 30 days. So when you are looking at how are people utilizing money, they're using it for everything. They're using it for their groceries, they're using it for shoes, they're using it for gas, they're using it to pay their car. That is what they're using their money for. So when you look at overdraft fees or banking relationships that aren't right, that's because people are using all of that money. And in low-income families, this is especially critical because they really get tied up in banking relationships that are inappropriate. So the FDIC did a study and they found out that there are two categories that I really want to hit on today, which is the unbanked and the underbanked. So some people have a bank account, but it's just not the right one, or it's not enough of a bank account. These are an enormous amount of households, and it's 80%. I mean, it's 18%. So it's 1 out of 5. But when I take that 1 out of 5 and put them into the lower 25% of the income strata, it becomes 80%. So it's really a critical item. What is interesting that has happened, this was a few years ago, that a market research company found that out of that 18% of people that have not enough banking, 11% of them were already shopping at Walmart. And they were going to Walmart locations a lot. So if you notice that Walmart has all of these offers, all of these things that they can do that are banking like, it's because that's their people. That's who's in their stores. So you'll hear me talk a lot and often about the difference between a credit union and a bank. Now they both have a benefit. I have an incredibly high bias because I believe in service to individuals. And this is the difference between the two. That a credit union is a nonprofit and a bank is a for-profit. And the institutions have different types of customers and they have different purposes. And a lot of the times these large banks don't do well with very small accounts. So credit unions often just treat you better, that they have different fee structures, they have more access to people who are starting out. I love credit unions for loans under a few $1,000s because they're able to take on the risk because they are serving the people that also put money into the bank. So it's another thing to really consider. I'm not going to recommend one over the other because sometimes having a larger bank is really quite helpful. There's lots of locations. You have other international services that are available. So you have to figure out which is the right type of relationship for you. Are you at a credit union or are you at a bank? One of the number one reasons that people talk about a bank is that it's FDIC insured. And FDIC basically is the Federal Deposit Insurance Company. And what that means is if the bank goes under, that your deposit is still covered. And the credit unions have something very similar, just has a different name under it. Banks have changed in their relationship to us. The banking rules and regulations have changed greatly in the last 15 years, but again in the last 10 years. Banks have become the purveyors of proving our identity. So when you are setting up an account, they're going to ask you for your identity first. They're going to ask you for a state or federal identification. They're going to ask proof of your residence. And so you have to have ID to be able to open an account. And that's kind of helpful because now you can just go to the bank and prove who you are. And terminology. This is where I'm going to kind of spend a lot of time. So if you're going to take notes while we're together, this is the place. I'm going to give you top 10 things that you should be knowing about terminology as it comes to banks, because it's a big deal. The checking accounts, this is not part of your top 10. Well, it is part of your top 10, but it's the last one. So we'll start with the last first. Checking accounts are deposit only. They're deposit accounts. But when you think about a checking account, what I want you to think about is it's a trading option, right? You're putting money in so that you can trade all day. And that's the purpose of that account. It's that you deposit an amount of money, and now you can make transfers, you can write checks, you can pay your bills, you can wire money. Your bank is the place that you are going to, it's the first relationship that you start trading with. It's where you receive money. If you are trading things, it's how you access an ATM machine. That is a trading account. And those deposit accounts, the reason that people get in trouble with them is because they're spending 97% of their money. There's only 3% of wiggle room in that account. And so if you're talking about $100, 3% is $3. Is it easy for somebody to make a $3 mistake? Absolutely. The average paycheck in the United States is still only $800. So if you have $800, you know, is it easy to make a mistake for $50 or more or less? Yes, absolutely. So that's why people get into trouble, is they just don't have enough money in their checking account. You always want to have at least $100 of wiggle room in a checking account. And that's the first thing that I remind people about. Don't run your checking account under $100 because it's just too easy for you to have forgotten something. And a checking account is not a one-term item. I remind people that when you say, oh, I have a checking account, someone like me who wants details about finance is going to go, well, what kind of checking account do you have? Because there's 11 different types of checking accounts. So when you start to look at what you want as far as features, how much are you going to run through there, how often do you take money out, you're going to have to figure out what is the right kind of checking account for you. Some people are just going, I want free checking. That's great. And some of them may not come with a monthly fee, but more and more banks are going to have fees attached to their checking accounts because they just cost money to manage. And if someone is overdrafting or they're using other networks for money, they are going to try to retain that cash. So there are many kinds. Here are the top 10 that you need to really pay attention to. The first one is routing number. It is a 9-digit number that identifies your financial institutions. And you have to know that if you're in a large bank, they have more than one. That they frequently have an individual geographic location of where you opened your account. So if you opened your account in Cincinnati, and that's where you opened your account, even though you may live in New York City, the routing number is going to go to Cincinnati. So it is important to know your routing number. If you do not know your routing number, find it out, because it's critical if you're doing automatic deposits, if you're paying automatic bills, that you need to know the exact location or what routing number they're using, because some banks have more than one. FDIC insured, we talked about this. This is really about bank failure. And then again, the credit unions just have an equivalent, but it's basically if the bank itself fails, your money is still secure. This came after, you know, banks went under, right? And not every country has banks that are insured. So it's a big deal. for many countries that their banking is safe. And that's part of why the monetary system works, is that we are safe. That if you put your money in the bank, you'll get it back. Number 3 is certificate of deposit. It's basically saying, hey, bank, I want you to pay me more interest on my money, and I'll agree to let you hold this for a certain amount of time. And it's a higher interest rate, and those interest rates vary from bank to bank and day to day. So you'll say, hey, you can hold my money for 30 days, 60 days, 90 days, 1 year, 3 years, 5 years. But that's really what you're doing, is you're saying, I'll hold that. A certificate of deposit, when money is inexpensive to get, these will not pay well. So if you have real low mortgage rates, certificates of deposit aren't going to be paying very well. When you have high mortgage rates, or it's cost to just move money around, then you'll see really good rates there. So in the last 10 years, the best rate we've seen is probably about 3%. The lowest rate we've seen is 1/4 of a penny. So they vary wildly. And one of the benefits is that when certificate of deposits are high, you lock in for as long as you think you can take it. So that happens a lot. APY, number 4, is the annual percentage yield. So basically it says, look, you're going to earn what percentage of interest? That's an annual, so it's over the year. So if you have $100 and it pays 2%, you're going to get $2. But they're going to push that $2 over a 12-month period. So you get a little sliver of it every single month. APR is the one that I really remind people to please take a look at, especially if you're filling out credit things, is that you will see these capital letters, APR, short for annual percentage rate, but you'll see a star after them, or an asterisk. If it has an asterisk behind it, it means there's an additional fee on there. And that is a really big deal. APR is how we figure out how you build your wealth. It's why it's number 6 after it is compounding interest, because interest can work for you and it can work against you. And having the ability for you to earn money instead of pay money is the first way that wealth gets reversed, right? We switch it up. And that is, again, how do we get your assets paying you as fast as we possibly can? And that's where compounding interest comes. Ben Franklin thought this was the coolest thing. He thought this was the 8th wonder of the world. And I agree that it is how we figure out how to build wealth. Compounding interest is, what is the interest rate and what is it over time? Time is actually what makes people wealthy, not just money. And that the time growth of interest is how you make money. The same thing is true of how you will lose money. If you're always paying a credit card and you're always paying them an interest rate, all of the wealth that's being transferred there is going in their favor and against you. So that's why compounding interest is big. You want to be able to earn on what you have. Number 7 is a savings account. Oh, the savings account. I remind people it's only 6 in a month. You can only access 6 times in a month for that account. Some banks will just stop giving you the availability to withdraw. So if you are at an ATM, if you're at an ATM and the ATM only lets you take $20 out, so you do it 5 times because you need 100, you'll use up 5 of the 6. And sometimes that's a problem. So know that the purpose of a savings account is to save for longer term items or emergencies. And the banks have given them their own designation. It's not a trading account like a checking account. It's a savings account. It's there to hold. And they put it on their books differently than a checking account. A returned item fee is when someone gives you a check and it's bad, the bank is going to charge you for that as well. Even if it didn't overdraw you, they're going to charge you for giving them bad money. So be careful who you get a check from. It's also why so many places like retail establishments stop taking personal checks because they don't want a returned item fee. An overdraft fee is if you don't have enough money to cover it. And sometimes banks will charge you an overdraft fee even if you have overdraft protection. So that's another piece where you have to really look at what are the rules. We talked about checking account. Again, that is really that's your trading account. It's where you're going to receive your wages. It's where you're going to put any money that you've earned into, and that's where you're going to kind of trade it out. A joint account can be a checking or a savings. It can be lots of different kinds of accounts. It can be a mutual fund account. It can be investments. But a joint account basically means that whoever are the names on that account, they both equally own the asset that is inside. They have equal rights to the money and they have equal ownership of the money. So if I own an account with my brother and my brother takes out all the money, I don't have a lot of recourse because he had as many rights as I did. So a joint account is that, where two people have equal rights and ownership of the money. So they can both trade on it. One of the things that I think most people forget in these lower income socioeconomic groups is the benefit of the post office. The post office, if you are doing any international money orders, things like that, is so critical to know that they have money orders that are very cost effective. But they are also the place to be able to cash a treasury check. So if it, the United States Post Office, it is a federal program. So it is part of the federal government. It will cash its own checks. If you work for the post office will cash your check. The post office was one of the first credit unions created because it was such a large employer. So if you have certain types of checks, they will do that. They will also sometimes do, and that's really dependent on how much cash they have on hand. If you open a till in a post office in the morning, they're not going to have any money. But if you come on a day where everybody's bringing money in so that they can get a money order for their rent check, they're going to have a lot of money on hand. So, think about what that looks like. The other thing about that is that they are really the lowest cost place to get a money order. And what is interesting about the post office is that many of those branches still provide third-party service. So if I have an account, if I have a check and it's made to me, I can actually sign that check over to the post office and get a money order out of it. So sometimes there's another way to utilize their services. So learn more is what I'm really saying, is go talk a little bit more to your postal provider. Because for people who have very limited means, the post office is still a service to them. Walmart is also one of the places where a lot of people are getting very basic banking done. One of the things that I don't appreciate about Walmart is that they don't have a system that allows you to find your money order again. And in fact, that's one of the things about money orders that I don't enjoy. If you lose it, you've lost it. That's why banking is so critical. If it's a lot easier to trace money on a check versus a money order. But the Walmart is offering more services because it's their core clientele. And a lot of people are using these prepaid debit cards or other credit cards as a bank, but I remind them that they're not a bank. They're not better than a bank. A bank is always, 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 in this country and in any first world nation, is always a mandatory starting point for building wealth. You need a bank account. The other thing that we're going to cover is opening an account, right? You have to prove your identity. And sometimes people are closed to opening an account. And that is 100% from this next page here, which is the check system. So just like you have a credit report score, you have a check system consumer score. You have a score from the bank. If you owe money to one bank, they all know. because it's listed on the check system. When you're going in to open an account, that's what they're checking, is the check system, to see, can they even open it for you? Because if you owe money to another bank, they're not going to do that. There are rules about people who do not pay banks back, and that means that they will no longer be eligible to have checking accounts. So sometimes they'll allow you to have a deposit-only account, but they will not allow you to have a trading account. So that's a really big deal. And getting a bank account for everyone needs one. And the reason I put the address on here is because you have to physically mail them a request. They're still old school. So if you would like to have a way to see what that is, what are the check fees that you owe other people, you mail them a letter, and they will kind of give you what's there. So let's talk about our next steps. Our next steps are, where are you banking, right? Where are you banking? That's the first question you should be asking yourself. Do you love your bank? Does it make you want to hug that place? If you don't love your bank, you should. So find a bank that's right for you. And that's really asking yourself some questions, right? What do I need out of my bank? And if you plan on borrowing money to be able to increase your own assets, so like money for a small business, or money for a car, or money for a computer, these are things that you need a banking relationship for. If you decide, so usually if it's under $3,000, that people are going to turn to credit cards, or they're going to turn to high interest credit cards. We see this at the dentist office, we see this at the veterinary clinics, we see this at all sorts of places that have guaranteed credit cards. They also are guaranteed to have more than a 30% rate. That they are very high interest rates because they're guaranteed, because they think you're a high risk. You might not be. So having a bank that you can access amounts of money from is critical. When the banks are open and you can go talk to a banker, they can pretty much look up everything and give you an answer for money that's under $3,000 within about a 30-minute period. So you can know the answer about, can I get enough money to fix my teeth, or fix my car, or fix my dog, or start a small business. Can I get that money quickly? And banks, a lot of them will be able to make small financial decisions based on your existing credit, and they can do that in about 30 minutes. So it's quick. It's quick. They've got to have a one-day period to file the paperwork sometimes, but most of the time they can just do it in one day, deposit it right into your account. So the other thing that I remind people is that your first financial goal, 100% of the time, is to build $1,000 in savings. To be able to have $1,000 in savings for most Americans means that they have a safety net and have some choices, and they can kind of not be worried about a $50 overspend. So you should always be putting something into savings, even if it's $1. That there has to be a way for you to be able to put some away for a rainy day, because it rains all the time here. So I want to thank you so much for taking the time to go through banking with me. This is a very introductory course. We have others, so I really want to recommend that you come and hang out with us some more. And I look forward to that. So thank you so much, and I'll see you again real soon. Bye.